So during this study session, we are going to learn about understanding income statements. So income statements usually present information on the financial result of a company's business activities over a period of time. What we usually want to know through an income statement is how much revenue a company has generated. Okay? The income statement is used by analysts, for example, equity markets or fixed income analysts, to examine a company's past performance and projected information on companies' abilities over their ability to make promised payments on their debt over the course of the business. So as an outline, we're going to cover the component of the income statement, how are expenses grouped, revenue recognition and its special cases, expense recognition and issues with that, non-recurring items and non-operating items, basic EPS and diluted EPS, the analysis of the income statement, the comprehensive income, and the accounting standards. Firstly, we're going to have a look at components of income statement. Firstly, we have a revenue. So usually on the top line of the income statement, companies will typically report revenue. Revenue is the amount charged for delivery of goods or services in the ordinary activities of the business over a stated period of time. Next, we find net revenue. So net revenue is revenue after some adjustments. And then we have expenses. Expenses are outflows of economic resources or increases in liabilities that usually cause a decrease in equity. And then we have net income. So net income can be either gains or losses. So when there is a gain, we usually have increases in economic benefits, and when there is a loss, we usually have increase in economic benefit. We usually have decrease in economic benefit when there is a loss. So a net income is given as income minus expenses. Okay? So if we break income minus expenses, you can have it as revenue plus other income plus gains minus expenses, or revenue plus other income plus gains minus losses minus expenses. When we are grouping expenses, so usually we group it either by nature, for example, depreciation, or we group it by function, example, cost of goods sold. Now, if I have sales and I have cost of goods sold, I can calculate my gross profit, which would be sales minus cost of goods sold. Okay? And here we have some special cases of revenue recognition. Revenue is recognized when the seller no longer bears risk with respect to goods, but in some special cases, for example, before goods are fully delivered or services completely rendered, we have a long-term contract which uses a percentage of completion method. Okay, so So what are long-term contracts? It's a contract that spans a number of accounting periods that raises issues in determining when the transaction has been completed and revenue recognition should occur. Okay, so it will use the percentage of completion method. Usually the percentage of completion method is a method of revenue recognition in which in each accounting period, the company estimates what percentage of the contract is complete and reports that percentage of the total contract revenue in its income statement. Therefore, we say net income or profit is reported each year as work is performed. Okay? And then we have at the time goods are delivered or services rendered. So that will use the normal revenue recognition criteria, which is revenue is recognized when the seller no longer bears risks with respect to goods. And then you have after the goods are delivered or services are rendered. So this usually comes with a doubt about ability to complete payments. For example, if you have a real estate project, for this type of issue, we use installment method or cost recovery method. Okay, so the outcome cannot be reliably measured. Okay, we use installment method, a method that specifies that the portion of the total profit of the sale that is recognized in each period is determined by the percentage of the total sales price for which the seller has received cash. Okay, and we have a cost recovery, a method of revenue recognition in which the seller does not report any profit until the cash amounts paid by the buyer, including principal plus interest, on any financing from the seller are greater than all the seller's costs for merchandise sold. Okay, so this is a review of what I've just said. Okay, percentage of completion, method of revenue recognition in which each accounting period the company estimates what percentage of a contract is complete and then reports that percentage of total contract revenue in its income statement. So the net income or profit is reported each year as work is performed. On the completed contract method, the company does not recognize any revenue until the contract is completed. If a project is started and completed in the same period, the percentage of completion equals the completed contract method. The installment method is a portion of the total profit of the sale that is recognized in each period is determined by the percentage of the total sales price for which the seller has received cash. Cost recovery method, the seller does not report any profit until cash amounts paid by the buyer are greater than all the seller's costs for merchandise sold. And then you have the barter system. In this, you have non-monetary exchanges, for example in e-commerce. And you have gross reporting. The company is the binary obligor under the contract, bears inventory risk and credit risk, unlike net reporting. For expense recognition, you have the matching principle, accounting principle that expenses should be recognized when associated revenue is recognized. And then you have period cost, LIFO, which means last in, first out, FIFO, first in, first out, and the weighted average method. Okay, so let's understand what happens. So usually with rising prices, you have if you're doing FIFO, first in, first out, so you have lower cost of goods sold with respect to ending inventory. If you are doing last in, first out, you have higher cost of goods sold with respect to ending inventory. And the weighted average is actually a middle value for cost of goods sold and ending inventory. So what happens with first in, first out, which is the items bought first will go out first, okay, which sometimes makes sense, whereas last in, first out. So for example, if you are buying like a stock of if you're a retailer of a stock of let's say kids toys, and that usually you get the last item will go first, because it's, if it's in a box, suppose it's in a box, and then usually the last items get on the top of the box, so that goes first. And then you have some issues with expense recognition. You can have doubtful accounts, warranties, depreciation, and amortization. So depreciation, here we're going to learn about two types of depreciation here. Whereas with straight line depreciation, where you need the annual depreciation expense, which is equal to cost minus residual value over the estimated useful life. The double declining method, you use the straight line rate, where you find 1 over t times cost minus residual value, and you need to find the acceleration factor. So here I've taken acceleration factor is always 2 times 1 upon t. So here I'm taking a 5-year a 5-year useful life, so that I double decline it 2 times 1 upon 5, which will get to 40%, and you need to multiply it by the net book value. We can do some examples in the next, not in this video, but in another video to look at these. And then you have non-recurring items and non-operating items. You have discontinued operations, that is, the company eliminates a component of its business, there is no significant ongoing involvement, and you can have an extraordinary item, that is a gain or loss, which is rather unusual in nature and infrequent in occurrence. For example, we can have a volcano, we can have a hail damage. Which is, if we do not have an extraordinary item, okay, we can have some examples of not extraordinary items. We have normal write-downs of inventory receivables, normal disposal of PPE, foreign currency devaluations, and the effects of the strike. So these are usually the kind of questions you might have, tells you whether it is extraordinary or not extraordinary, and you've got to be quite careful with that. Okay. And non-operating items are reported separately from the operating income, for example, interest expense on debt securities, amortization of any discount or premium. Next, we're going to learn on earnings per share, which is EPS. So first we have the basic EPS, okay, price to earnings ratio, which is calculated by net income minus preferred dividend over a weighted average of a number of outstanding shares. Okay, so to note that the diluted EPS is always less or equal to the basic EPS. The diluted EPS is equal to net income over the weighted average number of shares outstanding plus a new common shares issued at conversion. Okay, when a diluted EPS has convertible debt outstanding, we need to add the after-tax convertible debt to net income and subtract the preferred dividend. If we have a stock options, which is the treasury stock method, what we do, net income minus preferred dividend over weighted average number of outstanding shares plus the new common shares issued at option exercise minus shares purchased with cash received upon exercise times the proportion of year. So what happens if we have issues with diluted EPS? Usually we have anti-dilutive securities, which occurs when the diluted EPS is greater than the basic EPS. So in this case, we do not include the anti-dilutive securities in our EPS calculation. And then how do we analyze an income statement? So usually you have a common size analysis. You state each line of income statement as a percentage of revenue to facilitate a time series and a cross-sectional analysis. What you do, you have income statement ratios, for example, net profit margin, which is net income over revenue, gross profit margin, which is gross profit over revenue, and operating profit margin, operating income over revenue, and the pre-tax margin, earnings before taxes over revenue. And comprehensive income, other comprehensive income, which are items of comprehensive income which are not reported on the income statement. These can be comprehensive income minus net income equal to, alternatively, unrealized gain minus unrealized loss plus foreign currency translation. Comprehensive income equal to ending equity minus beginning equity plus dividend. So usually you can have questions where you're given ending equity, beginning equity, dividend, and you're asked to calculate comprehensive income. You might also be asked to calculate other comprehensive income if you're given net income. Other comprehensive income types, so foreign currency translation adjustment, unrealized gains or losses on derivatives contracts accounted for hedges, unrealized holdings, gains and losses on a certain category of investment securities, certain costs of the company's defined post-retirement plans but are not recognized in the current period. And next, we're going to review accounting standards. So we've read about revenue recognition. So there are two different accounting standards, IFRS and US GAAP. So under IFRS, cost expense in the period incurred, no profit recognized until all costs recovered, and you use the installment method. Under US GAAP, you use the completed contract method, the installment method, the cost recovery method. When we look at the costing method, IFRS allows FIFO and weighted average cost method, whereas US GAAP allows FIFO, weighted average cost method, and LIFO. It is to be noted that the LIFO costing method is not permitted under IFRS. Expense recognition. For expense recognition under IFRS, we have cost model and revaluation model. It requires separate component depreciation. It requires annual review of residual value and useful life. Under GAAP, we have a cost model, no separate component depreciation, and no review of residual value and useful life. When we carry out amortization under IFRS and GAAP, we can both use the straight line method. Non-recurring items and non-operating items. So usually under IFRS, we have discontinued operations. Under GAAP, we can have discontinued operations and extraordinary items. Extraordinary items not allowed under IFRS. Interest and dividends received, we have operating and investing statement in cash flow. Operating cash flow under GAAP. So you need to note this difference here. Interest and dividend received goes as operating and investing statement under IFRS. Interest paid, operating or financing under IFRS, and operating under GAAP. Dividend paid goes as operating or financing cash flow under IFRS and becomes a financing cash flow under GAAP. Usually in the barter system under IFRS, revenue recognized from fair value of similar non-barter transactions with unrelated parties, whereas in the GAAP, revenue recognized only if the company has historically received cash payments for such services. So that is the end of this video. We should review some questions in another video, which will be coming up very soon. Thank you for your attention. Give it a like and a subscribe.